Silver $91, gold $5,050. 6-tie recovery in 48 hours. While China shut out $6 trillion, reappeared in 48 hours. Gold surged 15%, silver 26%, the fastest recovery in modern precious metals history. But here's what they're not telling you. While Western markets celebrated, China's banks collapsed under buying pressure. While paper prices recovered, physical vaults drained at 5.9% per day. While governments held emergency summits, 50 nations scrambled to secure what's left. 2 million ounces vanished from registered vaults in 24 hours. The paper market says recovery. The physical market says something else entirely. And when governments classify materials as critical to national security, they're not reacting to abundance, they're positioning before the world realizes what's already gone. Welcome to IU and Ag, where we examine what markets reveal when the noise fades away. If you've been observing economic patterns long enough to recognize when something fundamental shifts beneath the surface, we'd appreciate you joining this community. There's a small subscribe notation below this frame. Consider it an investment in unfiltered analysis. We're curious. From which part of the world are you watching this briefing today? The patterns we're documenting are unfolding globally, and your perspective matters. Now, let's examine what 48 hours of market activity has exposed about the architecture holding our financial system together. On the morning of February 4th, 2026, traders across global financial centers opened their screens to data that defied conventional market logic. Gold had climbed 15.62% from Monday's lowest points. Silver had surged 26% over the same 48-hour window. Nearly $6 trillion in combined market capitalization had materialized across precious metals markets in less than 2 days. The speed was extraordinary. Gold prices had risen by almost $700 per ounce since Monday's bottom. By midday Wednesday, gold had reclaimed the $5,000 threshold, settling near $5,050 per ounce. For institutional analysts watching these movements, the recovery pattern itself wasn't unusual. Markets correct after forced liquidations. Capital returns when panic subsides. What made February 4th different was not the recovery, but what was happening simultaneously in the world's second largest economy. In China, something had broken. Reports emerged throughout the morning of widespread failures across major banking applications. Citizens attempting to purchase physical gold through bank-distributed investment products found themselves locked out of digital systems. The applications weren't offline, they were overwhelmed. Bank servers, designed to handle millions of transactions daily, buckled under concentrated demand for a single asset class. Young professionals in Shanghai, retirees in Beijing, middle-class families in Shenzhen, all attempting the same transaction at the same time. The capital was ready. The accounts held sufficient funds. The desire to purchase was clear, but the access had vanished. For observers familiar with market infrastructure, this represented something more significant than a technical glitch. When retail demand overwhelms institutional systems designed for mass participation, it signals a fundamental shift in public perception. Chinese citizens weren't panicking. They were making calculated decisions about where to store wealth during periods of uncertainty, and they were choosing tangible assets over digital promises. Meanwhile, Western spot markets showed silver trading at $91 per ounce. But in Shanghai, the same metal commanded $104 on spot markets and $101 in futures contracts. The premium was $14, a 16% gap between Eastern and Western pricing for an identical commodity. Market analysts reviewing this data faced an uncomfortable question. If Chinese demand was strong enough to crash banking infrastructure and willing to pay 16% premiums over Western prices, why was Western pricing rising at all? The traditional answer would point to arbitrage. When Shanghai pays more, metal flows east until prices converge. But convergence requires supply mobility. And multiple data points suggested that physical supply was not mobile. It was disappearing. The pattern emerging across February 4th carried echoes of previous market dislocations, but with a critical difference. In past crises, access restrictions appeared after prices spiked. Governments imposed capital controls after panic buying depleted reserves. Systems failed after demand had already cleared available inventory. This time, the sequence had reversed. Access restrictions were appearing during the recovery phase. Prices were rising, yet the largest consumer market on Earth found itself unable to participate. The system wasn't failing after depletion. It was failing while Western markets still quoted available supply. For portfolio managers accustomed to reading market signals, this sequence violated basic principles. When prices rise, access should improve. Higher prices attract sellers. Inventory becomes available, markets clear. Unless the inventory had already cleared and the price hadn't caught up yet. By afternoon in New York, gold had stabilized above $5,000. Silver held above $90 on Western exchanges. Financial media outlets framed the story as a recovery narrative. Markets had panicked Monday. Forced liquidations had created temporary dislocations. Rational pricing was returning. But in Shanghai, bank applications remained overloaded. And across the Pacific, inside the secured vaults beneath Manhattan and Chicago, a different story was being written in withdrawal receipts and inventory adjustments. The paper markets were telling the world that confidence had returned. The physical markets were telling a different story entirely. And the gap between these two narratives was widening by the hour. What happened over the next 72 hours would force market participants to choose which signal they trusted, the price on their screens or the metal they could actually touch. While financial headlines celebrated recovery, a different narrative was unfolding in the concrete vaults beneath lower Manhattan. February 3rd, 2026. The daily COMEX depository report arrived at trading desks like it always did, a routine administrative document that most analysts would scan in seconds before moving to more urgent matters. Except this report wasn't routine. 2 million ounces of silver had been withdrawn from COMEX registered vaults in a single 24-hour period. For context, the average daily movement in these vaults typically measured in tens of thousands of ounces. Gradual adjustments, routine rebalancing, the kind of inventory shifts that reflected normal market operations. 2 million ounces wasn't normal. It was the evacuation. The withdrawal wasn't concentrated in one location. It was systematic. Asahi reported 35,000 ounces removed. HSBC documented 400,000 ounces departing their facilities. JP Morgan recorded 1.2 million ounces withdrawn. But the largest single adjustment came from Brinks. The registered inventory had been reduced by 1.1 million ounces in institutional transfers that moved metal from available for delivery status into private storage classifications. When the accountants finished calculating, total COMEX registered silver had fallen to 103 million ounces. The total COMEX silver inventory across all categories had declined to 243 million ounces. The percentage was what made seasoned traders pause mid-morning coffee. 5.9% of available silver had exited the vault system in one day. If that rate continued for just 17 days, the vaults would be empty. Now, experienced market participants understood that extrapolating single-day movements was mathematically misleading. Vault flows fluctuate. A large withdrawal one day might reverse the next. But this withdrawal wasn't happening in isolation. It was happening while prices were recovering. Traditional market theory operates on a simple principle. When prices fall, physical buyers emerge. When prices rise, physical holders sell back into the market. This creates equilibrium. The vault inventory should increase during price recoveries as holders monetize gains. Instead, inventory was hemorrhaging. Across the Pacific, the Shanghai Futures Exchange reported its own inventory adjustment. 26,412 kilograms had departed in a single session. The Shanghai Gold Exchange documented 11,295 kilograms withdrawn over the previous week. The pattern wasn't regional, it was global. Something else appeared in that same COMEX data that caught the attention of derivatives specialists. Open interest, the total number of active futures contracts, had collapsed to multi-month lows. Open interest measures market participation. High open interest means speculators are active, traders are positioned, leverage is deployed. Low open interest means the hot money is left. The gamblers have been shaken out. Shanghai showed the same pattern. Open interest had completely evaporated. The leveraged positions that typically dominate precious metals futures had been liquidated. What remained were the counterparties who had no choice but to stay. The short sellers who had sold contracts they now needed to buy back. The physical demanders who had purchased contracts specifically to take delivery. And here was where the data revealed something extraordinary. Normally, only 1 to 3% of COMEX futures contracts result in physical delivery. The futures market exists primarily for price discovery and hedging. Most participants close positions before delivery obligations arise. During the recent crash, that pattern had broken. A significantly higher percentage of contracts were being held into delivery. Buyers who purchased during the Monday liquidation weren't closing positions. They were demanding metal. The crash hadn't been panic selling by weak hands. It had been a harvesting operation by informed buyers who understood that forced liquidations create the only windows when large physical positions can be acquired at temporarily suppressed prices. Someone had used the paper market panic to secure physical metal, and now they were removing it from the vault system entirely. By Wednesday afternoon, the directional conflict was undeniable. Paper markets showed recovering confidence. $6 trillion in market cap had returned. Prices had stabilized. Technical indicators suggested the worst was over. But the vaults told a different story. 5.9% daily drainage. Systematic withdrawals across multiple institutions. Open interest collapse. Elevated delivery demands. The paper market and the physical market were moving in opposite directions. For decades, this divergence had been theoretical. Market commentators had warned that paper pricing might eventually decouple from physical availability. that the hundreds of ounces of paper claims per actual ounce of metal would eventually be tested. February 4th, 2026. The test had begun, and the metal was leaving the system faster than prices were adjusting to reflect its absence. The question facing every institutional desk was simple. Which signal do you trust? The recovering price on your screen, or the emptying vault 3 floors below your trading desk? Because both couldn't be right simultaneously, and time was running out to choose. While traders debated paper versus physical signals, a different group of decision makers had already reached their conclusion. February 4th, 2026. Washington, D.C. The inaugural Critical Minerals Ministerial convened with an urgency typically reserved for active military crises. Vice President J.D. Vance stood alongside Secretary of State Marco Rubio before representatives from more than 50 nations. The stated agenda was diplomatic cooperation. The underlying message was considerably more direct. The global supply chain for essential minerals had become a strategic vulnerability, and governments were moving to secure access before markets fully recognized the shortage. These weren't junior trade officials gathering for routine discussions. These were senior ministers with authority to commit national resources. Australia sent its top mining administrators. Canada dispatched its natural resources leadership. The European Union brought its economic commissioners. When this many nations send decision makers of this caliber on short notice, it signals something beyond routine policy coordination. It signals that governments have access to intelligence that public markets haven't priced in yet. The meeting's timing was not coincidental. Just days earlier, President Trump had authorized Project Vault, a $12 billion strategic stockpile program for critical minerals. $10 billion would flow from the Export-Import Bank. Private capital would contribute the remainder. The structure mirrored the Strategic Petroleum Reserve, but for materials classified as essential to national security. Semiconductors, battery technology, defense systems, solar infrastructure, medical devices, and silver. For the first time in modern American economic policy, silver had been officially reclassified. The United States Geological Survey's 2025 critical minerals list now included silver alongside rare earth elements and strategic metals previously reserved for military applications. This wasn't symbolic bureaucracy. Critical mineral classification unlocked federal mechanisms that had been dormant for decades. Expedited permitting for domestic mining operations, direct federal investment in processing facilities, priority allocation during supply disruptions, tax incentives for companies securing domestic sources. Most significantly, it established the federal government as a buyer of last resort. When private markets faced shortages, government stockpiles would release supply. When private markets showed surplus, government programs would accumulate reserves. The policy created a floor under prices and a ceiling on foreign leverage. For portfolio managers analyzing this announcement, the economic implications were profound. Governments don't classify abundant materials as strategically critical. They don't authorize $12 billion stockpiles for commodities with comfortable supply margins. They do this when they've reviewed classified supply assessments and concluded the shortage is coming whether markets believe it or not. The geopolitical context amplified the urgency. China had spent the previous 18 months implementing export controls on rare earth elements and strategic minerals. Beijing wasn't cutting off supply entirely, just making it conditional, unpredictable, subject to political considerations rather than market forces. For American manufacturers dependent on these materials, the message was clear. Diversify your supply chains or accept strategic vulnerability. The Washington summit represented the coordinated response. Secretary Rubio was already scheduling bilateral meetings with South Korean officials. Separate frameworks were being negotiated with India. Australia and Canada were being positioned as primary alternative suppliers. The stated goal was resilience. The practical effect was an admission that dependence on concentrated supply sources had become untenable. But here's what made silver's inclusion on the critical list remarkable. Silver wasn't rare. Annual mine production exceeded 800 million ounces. Identified reserves numbered in the hundreds of thousands of metric tons. From a purely geological perspective, silver abundance far exceeded materials like lithium or cobalt. Yet governments were treating it like a scarcity metal. The answer lay not in geology, but in inventory location. Most silver existed in forms already committed to industrial use, or held in jurisdictions potentially subject to export restrictions. The available, deliverable, Western accessible inventory, the metal that American manufacturers could actually secure on short notice, was considerably smaller than headline production numbers suggested. Government analysts reviewing classified supply assessments weren't looking at total global production. They were looking at accessible inventory during potential supply disruptions, and that number was uncomfortably small. Ray Dalio had issued his own assessment just days before the Washington summit. The world is on the brink of a capital war, the Bridgewater founder had stated in a widely circulated analysis. Not a trade war, not a currency war, a capital war. where nations compete to secure physical resources before financial claims become undeliverable. When one of the world's most respected macro analysts uses that language, and governments immediately convened 50-nation emergency summits, the message to informed observers was unambiguous. The shortage isn't theoretical anymore, it's operational. And governments are positioning before public markets, force prices to reflect physical reality. In Dubai, premiums for physical silver had reached 15% above spot prices. In China, bank systems were collapsing under buying pressure. In New York, vaults were draining at 5.9% daily. And in Washington, 50 nations were signing frameworks to secure supply chains for a metal that markets still assumed was abundantly available. The paper price said recovery. Government action said emergency positioning. One of these signals was accurate. The other was about to be proven catastrophically wrong. February 4th, 2026 was not the end of the story. It was the midpoint of a larger structural shift, and multiple risk vectors remained unresolved. While precious metals recovered and governments mobilized strategic responses, a different crisis was building 8,000 miles east of Washington. Tokyo's bond market was fracturing. Tuesday's auction for 10-year Japanese government bonds had produced a bid-to-cover ratio of 3.02. For observers unfamiliar with bond mechanics, that number meant that for every bond offered, slightly more than 3 buyers submitted bids. Under normal circumstances, that would indicate healthy demand, except Japan's 12-month average bid-to-cover ratio was 3.24. The previous month had produced 3.3. Demand was deteriorating. And in bond markets, deteriorating demand means rising yields. Rising yields mean higher borrowing costs. Higher borrowing costs in the world's third largest economy mean global contagion risk. Japan's 10-year bond yield had climbed to 2.26%, the highest level since 1999. A generation of investors who had never seen Japanese yields above 2% were now watching this threshold break in real time. The timing was particularly dangerous. Japan faced a snap national election on February 8th, just 4 days away. If the ruling coalition secured victory, Prime Minister Sanane Takai had already signaled intentions to pursue additional fiscal stimulus programs. More stimulus meant more government borrowing. More borrowing meant more bond issuance. More issuance into a market, showing weakening demand, meant potential auction failures. And on Thursday, February 6th, Japan had scheduled another critical test, the 30-year bond auction. If that auction produced weak demand, the message to global markets would be unmistakable. Investors were losing confidence in Japan's ability to service its debt obligations. For precious metals markets, this created a paradox. Bond market failures trigger immediate risk-off sentiment. When major government debt markets show stress, institutional investors liquidate everything. Stocks sell. Commodities sell. Precious metals sell alongside everything else in the initial panic. But the secondary effect moves in the opposite direction. Once the immediate liquidation passes, capital seeks safe haven assets. And historically, nothing represents safe haven like physical gold and silver during sovereign debt crises. The pattern had played out before. Initial shock creates indiscriminate selling. Then reality sets in. If government bonds aren't safe, what is? And capital flows toward tangible assets that carry no counterparty risk. The current situation in precious metals presented decision makers with an uncomfortable calculation. The $6 trillion recovery suggested the worst was over, but if Japan's bond market broke, another wave of forced selling could materialize before the final safe haven bid emerged. Geopolitical risk added another layer of uncertainty. President Trump had confirmed that negotiations with Iran were ongoing. The phrasing was careful, diplomatic, but it carried historical weight. Previous military incidents involving Iran had triggered immediate market liquidations, followed by sustained safe haven flows. The pattern was predictable. Geopolitical shock creates fear. Fear creates selling. But once the immediate reaction passes, the underlying concern remains. And that concern drives capital toward assets that maintain value regardless of political outcomes. The volatility wasn't finished. Japan's bond stress and Iran tensions guaranteed that much. But beneath the volatility, the physical fundamentals were tightening regardless of paper price movements. Every day, more metal left the vault system. Every day, China's retail buyers faced access restrictions. Every day, Dubai premiums widened. Every day, government officials reviewed supply assessments that public markets hadn't priced in. There was another data point that sophisticated analysts were monitoring closely. Bitcoin had fallen below $76,000. Measured in dollar terms, that might seem elevated compared to historical levels, but measured in gold terms, the picture looked considerably different. At current prices, Bitcoin was worth approximately 15 ounces of gold. At its peak ratio in November 2021, Bitcoin had commanded significantly more gold ounces per coin. The gold to Bitcoin ratio had shifted dramatically, and not in Bitcoin's favor. For investors who had viewed cryptocurrency as digital gold, this divergence raised strategic questions. When measured against the asset it claimed to replace, Bitcoin had lost substantial ground. Meanwhile, physical gold and silver were seeing government reclassification, strategic stockpiling, and vault drainage. The market was voting, and the vote favored tangible assets over digital promises. This created the central unresolved tension facing every institutional decision maker. $6 trillion had recovered in 48 hours. That suggested confidence returning, markets stabilizing, the worst of the liquidation behind us. But simultaneously, vaults were draining 5.9% daily. China remained locked out of physical purchases. 50 nations had convened emergency mineral summits. Silver had been reclassified as critical to national security. Hope and interest had collapsed to multi-month lows, leaving only short-covering banks and physical demanders in the market. Both narratives couldn't be accurate simultaneously. Either the recovery was real, and the physical tightness was temporary noise that would resolve as supply chains normalized. Or the physical tightness was real, and the paper recovery was the temporary phenomenon that would collapse once delivery demands overwhelmed available inventory. For portfolio managers allocating capital, this wasn't an academic question. It was a binary outcome with trillion-dollar implications. If Japan's bond market failed, if geopolitical tensions escalated, if another forced liquidation wave materialized, would that create one final accumulation opportunity before physical shortage forced the breakout? Or would it expose the paper market as fundamentally disconnected from physical reality? The answer would emerge in the coming weeks. But the data available on February 4th suggested something profound was shifting beneath the surface of financial markets. When governments classify materials as critical and launch strategic stockpiles, they're not reacting to current abundance. They're positioning for future scarcity they can already see in classified assessments. When bank applications crash under buying pressure in the world's second largest economy, it's not a technical glitch. It's a system unprepared for what happens when populations lose faith in financial abstractions. When vaults drain at nearly 6% daily while paper prices recover, it's not a temporary divergence. It's the early stage of a repricing event where physical reality overwhelms paper claims. The volatility wasn't over. Japan's bond auctions and Iran negotiations guaranteed more turbulence ahead. But the underlying trajectory had been established. Physical metal was disappearing from accessible inventory at rates that couldn't sustain for long. Governments were positioning as if shortage was inevitable, and the gap between paper pricing and physical availability was widening every day. For those watching carefully, the outcome was no longer in question. Only the timing remained uncertain. The paper market would eventually acknowledge what the physical market already knew. The only question was whether it happened gradually or suddenly. And sudden repricing events tend to favor those who positioned early.